Okay, thanks for standing by as we switch gears to talk about the statement of cash flows, the fourth and largest, one of the largest financial statements in financial accounting. The statement of cash flows is really important, and the reason why it's so important is because it tells us managers, business owners, about the cash coming into and out of the business. That's why it's called the statement of cash flows. It's the cash coming into and out of the business. Cash flow, physical flow of cash. In business, we look at cash in three different ways. We use cash for operating the business. It's the day-to-day operations of the business. We use cash for investing into things like property, plant, and equipment. And we also use cash for financing, taking out loans, repaying loans, issuing stock, issuing bonds, financing. So those are three primary reasons and uses of cash in a typical business: operating, investing, and financing. And so I'll talk to you in depth about all three of those categories on the statement of cash flows. We will also learn how to prepare the statement of cash flows using the direct and indirect methods. So first, let me talk to you about those four concepts: three: operating, investing, and financing activities. So, what is the statement of cash flows? Why do we care about it? Why are there three different categories of it? It tells us who's paying us, who we're receiving money from, customers. It also tells us who we're paying money to, our vendors, our employees. The operating activities. It also tells us about the types of investments that we're making: purchasing property, plant, and equipment, or selling property, plant, and equipment. Okay, that's investing. The financing, the statement of cash flow tells us how we are taking out loans, repaying loans, issuing stock, issuing bonds, kind of thing. That's why we do it. That's why we prepare the statement of cash flows. It tells us about the physical flow of cash into and out of the business for those reasons. Why is it helpful? Managers can plan the day-to-day operations of the business by looking at the statement of cash flows from the operations. I can see how much cash I'm spending on inventory, or on payroll, or on utilities, whatever, rent. I can see those things from the cash outflows in the operations section of statement of cash flows. I can also see when my customers are paying me. The cash that I'm receiving from my customers from over-the-counter sales, but also the cash I'm receiving through accounts receivable. Remember, some time ago we talked about the aging report. When we talked about receivables, we talked about accounts receivable. We talked about, sometimes customers, they take some time to pay us. Well, knowing that is really important. Knowing when you're expected to receive cash from your customer. because it helps us to plan the day-to-day operations of the business. That kind of information is also helpful for one to figure out when to purchase property, plant, and equipment or sell it. And it also helps the company to look at other opportunities. A couple of different things. Very helpful, very important. So, a couple things you need to understand when it comes to measuring cash flow. One is how quickly I'm converting my accounts receivable into cash. And two is understanding when things come to maturity. And interest rates affect those things. These things help us to measure the cash flow. As I'd mentioned, there's three categories on the statement of cash flows. Operating activities, those come from the day-to-day operations of the business. Cash coming in from our customers, cash going out for operations like payroll, rent, vendors, inventory, etc. Taxes. That's operations, day-to-day operations of the business. Second category is called investing. That's the purchase or sale of property, plant, and equipment. And the third is called financing. That's issuing stocks and bonds or selling stocks and bonds, or purchasing stocks and bonds, or loans, interest, dividend payments, and financing. Again, operating activities, day-to-day operations of the business. Cash coming in from our customers, whether that's from over-the-counter sales, receiving cash from our accounts receivable that we made in the past, or maybe we're also receiving some interest revenue or dividend revenue, cash coming into the business. And then the cash outflow is cash leaving the business for reasons like paying our wages, operating expenses, paying our vendors, rent, etc., paying interest, paying taxes, etc. Operating activities. The investing activities is the purchase or sale of property, plant, and equipment. Also some short-term or long-term investments, like we talked about in the previous chapter. Financing activities has to do with things like stocks, bonds, loans, also known as notes. Of course, any type of owner's contributions or withdrawals. Financing. So based off of those activities, operating, investing, and financing, notice that they're connected. Not just, of course, on the statement of cash flows, but the statement of cash flows is connected to the balance sheet. How is it connected to the balance sheet? Well, the obvious one is cash. That's an asset. So cash on the balance sheet, the cash balance on the balance sheet is connected to the cash coming into and out of the business for all three categories. It's also connected through liabilities, through loans, right? Through accounts payable, through notes. Also connected to long-term liabilities through notes. The repayment of that debt, right? The liabilities. And it's also connected again to the assets, the long-term assets for the purchase of property, plant, and equipment. or sale of it. On the financing side, yeah, looking at those loans. So we can see the connection between the statement of cash flows and the balance sheet. Yeah, they're very closely related. And honestly, the income statement as well, through sales and expenses. So sometimes there might not be cash involved in investing and financing. You might be wondering, well, how's that possible? Sometimes an owner might contribute property, plant, and equipment to the company in exchange for stock. Absolutely, that's totally possible. Or we learned about earlier, when it comes to debt or equity, it's not necessarily for cash. The debt can be converted to equity in the form of stock. Yeah, so those are entirely possible. So not everything is connected to cash, but most things are. So that's why it's important for you to know that there's two ways that we would prepare a financial statement. One is called the direct method, and the other is called the indirect method. And we'll talk about both of those. The easiest, of course, is the direct method. And it's because it follows the cash directly. Well, here's what I mean by that. This is your typical format of a statement of cash flows. Operating activities at the top, in the middle we have investing, at the end we have financing, and then of course we have the net cash. Cash at the beginning of the period, end of the period, right? You'll notice that it's just one in each category here. This is more or less of the direct method. We take the cash inflow minus the cash outflow to equal net cash flow. We apply that same formula to operating, investing, and financing activities. That's why there's only one amount in each of those categories. We add those all up together to get the net. Okay, increase or decrease in cash. And then we take the cash balance at the beginning of the accounting period. We add that to the change in the net cash flow to equal the ending balance. You see? So a couple steps to prepare the income, the financial statement of cash flows. First is we take the net increase or decrease in cash. We find the net cash from operating activities, net cash from investing activities, net cash from financing activities, and we compute all of these sources on the statement of cash flows in that order to find the ending balance of cash. So one of the ways that we would do that is by looking at the cash coming into the business and then out of the business. So where is our cash coming from? Some of it comes from customers. Some of it comes from issuing stock. Some of it comes from selling assets. That all represents cash coming into the balance. If you look at the T account here, we see that this account is for cash. It's one of our subsidiary ledger account. It's one of our ledger accounts. Cash. Looking at cash, on the left side we see the cash coming in, because remember, cash coming into the business is debited. On the right side we see the credit for cash. Payments for inventory, operating expenses, interest, taxes, note retirements, dividends. Take a look at each of these line items. Okay. The left side, we got cash coming in from our customers. That's obviously operating activities. Is it operating? Because that's what we do. We sell to customers, day-to-day operations of the business. So cash coming in from our customers, that's operating activities. Cash coming in from the sale of assets, that's investing activities. Sold property, plant, and equipment, that's investing activities. Cash coming in from issuance of stock, that's financing activities. On the right side, we got payments for inventory, operating activities. Payments for operating expenses, operating activities. Payments for interest, financing activities. Payments for taxes, operating activities. Payments for note retirement, financing activities. Dividend payments, financing activities. Just by knowing and understanding where cash comes into the business and out of the business and for what reasons, you can easily categorize them on your statement of cash flows. And of course, we have a couple non-cash things that happen. The non-cash part comes from the exchange of equity or debt for investing or financing activities. So in order to find and understand the non-cash amount, we take this formula here. It's cash balance equals liabilities on the balance sheet plus equity on the balance sheet minus non-cash assets. Let me break that part down for you. The non-cash assets on the balance sheet, that's all of your long-term assets and probably inventory as well. Non-cash. So, a couple of pieces of information you need to have available to you before you prepare the statement of cash flows. Comparative balance sheets. This is when we're comparing one accounting period to another, with the difference, the change between those two. Current income statement from the current year. And of course, some additional information like possible transactions that have happened or will happen in the future. Now we can compute it, the statement of cash flows. I'm going to show you the direct and indirect methods. There's a big difference. Indirect method is very hard. I'll tell you that part up front. Here's how it works. As I mentioned earlier, with the direct method, it's very simple. All we do is we take the cash coming into business minus cash going out of the business to find net cash flow for operating activities, investing activities, and financing activities. Here we have at the top of this slide an example of just the operating activities. And you'll notice it's cash received from customers minus all of the cash paid for operating reasons. Paid for inventory, paid for wages, paid interest, paid taxes. Net cash flow, $20,000. Okay, that's the direct method. It's very straightforward. It's very direct. Where the name comes from. What about the indirect method? This is a little bit more complex because you'll notice that in order to calculate the net cash flow for operating activities using the indirect method, all of the items on this method are not cash based. Okay, so how do we calculate it? We start with net income. Income, as you know, represents the remainder after all the expenses have been paid after sales. So sales or revenue minus all your expenses equals net income. That's on your income statement, right? That's why that net income amount is important. We take net income. Then we look at all of the non-cash things. Well, some cash things. We look at the following items. Accounts receivable. Changes in inventory. Prepaid expenses. Account payable. All of your other payables. We also look at depreciation expense. Gain or sale from assets. And of course, gain or sale from other things like notes. That's why it's indirect. Okay, there are items that do not have a direct effect on cash. The indirect method, well, yes, it's the most complex, it's the most accurate. Okay, so it's net income minus increase of accounts receivable. Now you might be wondering, Dr. B, why is it minus? You just said increase in accounts receivable. Why would it be minus? The reason for that is because when your accounts receivable goes up, that means you're not collecting as much cash. You will collect that cash in the future, but not right now. You see? That's why it's minus. So minus increase from accounts receivable, minus increase from merchandise inventory. Same reason. You purchased more inventory. That's why there's an increase in it, right? That means more cash went out. Minus increase from prepaid expenses. Again, more cash went out because there was an increase. Minus a decrease in accounts payable. Dr. B, I thought you just said increase is opposite. No. When you see decrease in accounts payable, that means your average accounts payable went down. That means more cash went out. You've used it to pay down your accounts payable. So cash went out, decrease in accounts payable, minus. Decrease in interest payable. You paid down more of your interest, get more cash going out, right? Okay, so for the minuses, then we're going to add some stuff back in. Plus, an increase from income taxes payable. You might be wondering, why would that be positive? Why would that be a positive thing for cash flow? The reason why it's positive is because an increase in income taxes payable means you paid less in income tax. It means you didn't pay as much out. It means your cash went up by that amount. Increase in depreciation expense. Add that in as well for the same reason. Increase from the loss of sale of plain asset minus the gain on retirement of a note equals net cash flow 20,000. That is the indirect method. as I mentioned, it's the most complicated way to find net cash flow from operating activities. It's the most accurate. Yeah. Any questions on that? That is probably the most difficult part about the statement of cash flows. Oh, good. You're sure you're good? All right. Okay. This shows you the relationship between the income statement and the balance sheet, and ultimately the statement of cash flows. Shows you the connection. Yeah. Shows you how we used that information and applied it to the statement of cash flows in order to understand how we derived net cash flow from operations. Yeah. In a simple way of looking at it. So a couple of things I wanted to talk about. Sometimes we need to make adjustments, as you know, during the year. Things like depreciation, the loss of sale of plant asset, gain on a retirement of a debt. These types of adjusting entries don't have an effect on the actual cash, but it does when we're calculating the indirect method on the statement of cash flows. So these adjustments, of course, have an effect on the balances on the balance sheet, and this is kind of what this summarizes. And as we saw, in looking at the indirect method, we saw the decrease in the current assets. We saw increases in current assets based off of those changes. So, so that's why we subtract out increases and some of the decreases as well. And then ultimately derive the net cash from operating activities. So yeah, it's complex. It is, but it's important to know because it's again the most accurate way to do it. What about the investing and financing activities? Those are a lot more straightforward. Okay. Of course, for investing, we're looking at the changes of fixed assets, property, plant, and equipment, to help us to determine the changes in investing activities. And so here we see beginning balance there on the left, ending balance there on the right. Here we can see a change in plant assets, which tells us that, yeah, we must have sold like a building or something. Yeah. Of course, that's how we would figure out what's going on with investing. Here we have a sale of a building. Here we have purchase of a building. Top one here, line B, looks like we purchased the building for $60,000 using a note payable. We did some stuff with it, I guess. It looks like maybe we sold something else. Oh, we sold like equipment. It looks like we have depreciation. So these are the types of transactions that we would record. But yeah, it's very straightforward with investing and financing activities. The financing activities, we look at the changes of financing activities with respect to things like the balance of notes payable, the interest payable, those types of accounts. So some of the information we would look at here, especially when it comes to financing, is we look at notes payable. What was the change in notes payable? So here we have a decrease in our long-term notes payable, which translates to additional cash going out for that reason. An example of that, we paid a loan in advance of its maturity date. So we debit notes payable, credit a gain on the retirement of the debt, and credit cash for the actual cash that was paid. Yeah. So that's financing activities. Here we have a common stock transaction. It looks like we issued $15,000 worth of stock. Number of shares times the par value issuance. And of course, if there was a difference, if we issued it at a premium or a discount, there'd be that difference. And of course, we make sure everything balances. Using the differences here. We take the increase in net cash flows plus the beginning balance equals the ending balance. What we do is we take those figures and we match those up to our cash balance on the balance sheet. Yeah, that's the statement of cash flows in a very general sense. And of course, there's a couple of ratios that you should know about, and we'll talk a little bit about those as well. So let's look at those ratios, but let's also look at and better understand the cash flows in a general sense. For a management perspective, it's so important to review the statement of cash flows because we need to best understand when cash is being received from our customers, whether it's cash over the counter or credit sales, meaning on accounts receivable, which helps us to plan for future investment, right? It also helps us to understand what are good times to repay debt, etc. That's why those cash flows are so critical. So one of the ratios that we calculate is called the cash flow on total assets. This gives us a really good idea of the utilization of our assets in comparison to the cash that is being generated from them. Okay, we take the operating cash flow, net cash flow, divided by the average total assets. Again, with averages, it's beginning balance plus ending balance divided by 2. We could use a spreadsheet to analyze that statement of cash flows to identify those changes. Which helps. Excel is a great tool to use. I always recommend using Excel when it comes to doing complicated things like this. And of course, the direct method in comparison to the indirect method, the direct method is the easiest, as I had mentioned. It really just is looking at the cash coming into minus the cash going out of the business for operating expenses to find the net cash flow. Yeah, very, very straightforward. And this is just a nice little summary of the effects of the statement of cash flows. Any questions at all on the statement of cash flows? Any questions at all about the statement of cash flows? Did we do okay? Any questions about it? Anything at all? You're sure? You're sure there's nothing? I'm not on mute. I haven't been talking to myself the whole time.
No, Professor, we're here.
Okay. All right. Just want to make sure. I care about y'all, and I want y'all to do well with this stuff. Okay, so that's the statement of cash flows. I am going to stop this part of the recording. We're going to start another recording a third one to talk about the final exam. So please stand by.